Hi, my name's Sean. I'm one of the co-founders with Bitsilk Investments, and today I want to take you through our long idea for Sandstorm Gold. We have a price target of $10.98, which gives us implied upside of 17%. So the first driver is the gold price, and the higher it is, put simply, this directly influences the miners' revenues, which they have a portion of. The second driver, which is more specific to the streaming industry, is the deal pipeline. And this is important because streamers rely on being able to acquire portions of a mine's production. So it's helpful for the landscape to be supportive. COVID-19 has hit the deal landscape as it is often difficult to do due diligence of mine without being able to get near the site. And according to senior bankers in the industry, from a Reuters article, the deal landscape was shaped before COVID. And from Sandstorm's perspective, they haven't had any issues with their pipeline and already have acquisitions lined up in 2020 and 2022. We made a full video on the macroeconomic reasoning that underpins why we are bullish gold, which will be linked below, but I'll quickly gloss over the reasoning myself. So we've had central bank monetary debasement with the balance sheet at $7 trillion. Interest rates are likely to stay at the zero bound until 2022, according to the Federal Reserve dot plot, which is going to antagonize the scramble for yield. And in the past, higher rates were what always cut the party short for gold, but there's less chance of this happening, especially with the potential for yield curve control. Central banks have been buying over the past years, notably the PBOC and the Indian Central Bank. There's potential for gold to be included as a counterbalancer within a basket of currencies that underpin special drawing rights. Then there's also a thesis out there by Jim Rickards regarding currency wars and why a weak dollar is good for gold. And there's also some great ideas behind why we're at a dollar top now. Also, if modern monetary theory starts to gain traction, given that it's worked so well, this is this is up for discussion. But if MMT is seen to have done well and it starts to gain traction, there's a much higher risk of inflation. And then there's that added bonus that gold acts as a geopolitical hedge, which is kind of plays into the idea of why it's a risk-off asset, which is another bullish flag. So now I want to talk about Sandstorm's business model. And in our previous video, we covered the different kinds of gold companies, and I'll leave a link for that in the description. So I'll cover Sandstorm in a bit more detail this time. So they're a streaming company with 33% of their portfolio in NSRs, i.e. net smelter revenues, meaning that they pay X amount up front and then receive Y percentage of the revenues per annum until the mine is depleted. They buy the gold at an agreed percentage of market price, meaning their market margins on this buying and selling are fixed and are thus very favorable for Sandstorm. The only cost tied to NSRs that run through the income statement is the depletion of the mines, which reflects the gold removed from its estimated reserves. One of the added bonuses that makes Sandstorm so special is the optionality that they have within their NSR portfolio. Their Arizona mine has triggers at $1,500 and $2,000 gold, which increased the percentage on the NSR contract to 4% and 5% respectively. Because they were previously acquiring junior miners, they also have a portfolio of around 100 development assets that start producing profitably when gold rises above $2,000. Since we didn't want to make spurious assumptions, we chose not to model this, hence why we refer to it as optionality, because it's the option to switch on that production given gold hits $2,000. The remaining 66% of their portfolio are royalty streams, which means that they take a share of the profits instead of revenue like net smelter revenues. Sandstorm typically accounts for the cost of each mine under their gross margin, so we have followed the same protocol. These kinds of streams are similar in that they take very little to operate, but do offer a little less in the ways of operating leverage than net smelter revenues, as they incur both cost of goods sold and depletion. So before we go further, you might want to know why Sandstorm instead of spot gold or other junior miners. And there are many different ways to invest in gold. So you can go long the physical bullion, but you're going to have to pay a premium for that benefit. You could go long the futures, but then you're going to lose interest on the margin that you place in collateral. Finally, junior miners you can also invest in, but they can be likened to biotechnology companies and fluctuate rapidly depending on, pardon the pun, but quite literally whether they strike gold or not. Then there are the streamers, which have a huge array of benefits. And I alluded to this earlier. Sandstorm has huge optionality on the price with their development assets and net smelter sliders, Equinox being the example I spoke about before. So when you buy Sandstorm, you get this inherent leverage to the gold price that you wouldn't in mine operators or derivatives that track the spot. To further sweeten the deal, you don't actually have to pay for this optionality like you may do with a call option. And instead, it's very likely that you're going to get paid for the benefit of owning the stock, with them looking to instate a dividend later down the line and 3 million shares left on their buyback program. In terms of risk, streamers are a great option because you don't have to worry about due diligencing each mine yourself. And often in the junior miner space, there are aspects that are tough to capture without flying out to the site, talking to the geologists, and really kicking the tires for yourself. So one solution is to pay an active manager to undergo the stock selection and portfolio construction in exchange for a fee. Or you can let Sandstorm do it absolutely free of charge. And their CEO, Nolan Watson, is arguably the Muhammad Ali of the streaming industry, with a corporate development and geological team that is second to none. Furthermore, Sandstorm have reached a pivotal point in their life cycle where they are looking to start acquiring mines that are cash generating within 12 to 24 months. They've already put in significant capex to build the streaming base that they have today and are now in a position to finance their operations entirely by cash and debt. This is ideal because it embeds a downwards trajectory on their cost of capital, since their debt has much more favorable terms than their cost of equity. Finally, this isn't a point that I want to make my case based on, but in a liquidity-driven market, it's something I wanted to touch on. Like I glossed over before, gold miners take a lot of due diligence before investing, because if you're buying hard assets, you have to be sure that they are represented properly, and it's important not to underestimate the power of the social license to the success of a gold mine's operations. Therefore, there is certainly value in the streaming space purely for having much lower barriers to invest. So if momentum turns towards the real asset narrative, then Sandstorm is in a great position to be the beneficiary of these money flows. So now I want to touch upon the geographical standing and then elaborate a little bit on their portfolio. So they are based primarily out of North and South America, with the remaining 20% in emerging markets. Their portfolio is very strong with some of the big names that they have a share of, including Eldorado Gold and Equinox Gold. In terms of currency, they have structured it in a way that they receive all of their revenues in dollars. So their mainstream is protected from the risks that come with the US dollar CAD pair. Their only exposure is in wages, which is paid in Canadian dollars. However, this is less than 6% of the revenues year over year, and a 10% move either way will not have a material effect. So now I want to take you through their management, and I'm pretty confident in saying that we have an all-star C-suite. And if the mining industry were the NBA, then Nolan Watson is Michael Jordan. He has a track record of winning and is known as one of the forefathers of the precious metal streaming industry, having successfully funded and grown Silver Wheaton to be the largest streamer in the world. He has a very market-savvy finance and corporate development team, drawing on a mix of accounting, brokerage, and market-facing backgrounds. It seems that everyone who will be spearheading the due diligence and acquisitions within Sandstorm have the qualifications, experience, and track record of success to deliver. Additionally, on the project evaluation front, they are certainly not lacking and have their fair share of fully qualified, commercially experienced geologists. So in terms of management, strategy, and team, Sandstorm leave very little to be desired. In regard to incentives, you can see that they hold a good amount of the float, with all senior executives receiving the lion's share of their remuneration in share-based compensation. Looking at some other holders, a lot of the float is held by index funds like BlackRock and Vanguard, so I'm not going to waste time talking about that. However, we do see some high-profile hedge funds invested as well, namely Asvalor, who are a value fund, and Dimensional Fund investors, who seem to be the highest conviction within the alternative investment space, who are invested in this business. FYI, they have $454 billion AUM. Finally, what I found interesting was that quant funds own a combined 2.92%. So please don't quote me on this, but it could mean that Sandstorm fall into a factor strategy like momentum or growth, which is a good thing for the traded volume of the stock. Taking it further, now that we know who is managing, let's take a look at what they plan to do. So they plan to shift towards more cash-generating mines to expand their already rich portfolio of established and development assets. They plan to finance these future acquisitions through their revolving credit facility and retained earnings. They pay a variable rate on their revolver, which is tied to LIBOR on a sliding scale of 3 to 4.22%, dictated by their leverage ratio. This is a very favorable rate, and transitioning away from equity financing is going to do wonders for their cost of capital. Especially with rates likely to remain near zero through 2022, not only is this bullish for gold itself, but it's also bullish for their floating rate liability. Over the past 10 years, they focused on establishing themselves as an investable streamer and were known for acquiring growth assets. However, now, since they are transitioning towards cash generative and they have the means to do so, I see them as a real competitor to Franco-Nevada. So on the topic of Franco-Nevada, we can see that the three streamers tracked each other quite closely in terms of percentage appreciation. And the main way that these miners compete is on acquiring streaming deals. However, given the high levels of expertise and capital required to effectively due diligence a deal properly, there aren't many successful streamers. And another point is that investors have been burnt on gold miners pretty badly over the past 10 years, so they don't have much bargaining power. So the fact of the matter is that mining is a risky business and there will always be demand for capital. So there are plenty of royalty contracts available for investors who are willing to do the work. So now I want to bring it all together and showcase my assumptions I used to arrive at a valuation. So my goal here was to allow as much room as possible for positive surprises on the margin and cost of capital. So you could say my valuation is very conservative. I assume that the gold price will evolve to $2,200 over the years to 2024. My volume estimates were much lower than management, especially in 2023, where although their estimation is reasonable based on the portfolio, I left some rooms for delay in the opening of their Hod Madar mine in case the timeline has been pushed back because of COVID. I wanted to capture their strategic shift to cash-generating mines, which are supportive of lower depreciation and impairment, since established mines have much more stable lifetime and surety in their estimated reserves. So I embedded a 10% decline in depreciation or depletion over the years to 2024. With regards to running costs, since they are primarily wages and overheads, I calculated them as a function of revenue, which has worked out over the past 5 years. And I did the same for working capital, which I can get away with as it has historically been a small proportion of the company's top line. Also, I assumed that they will draw half of their revolver by 2024. However, I did not adjust their capital structure to reflect potential share buybacks, which leaves further room for surprise upside regarding their weighted average cost of capital. My cost of equity assumptions were extremely pessimistic as I inflated their beta and market risk premium to account for higher correlations in markets over the recent 2 months. Finally, we assumed a very, very pessimistic cost of capital, bringing together all of those facts that I mentioned before, namely not reflecting buybacks in their capital structure and higher cost of equity. So, based on my evaluation, I found that although Sandstorm and Franco-Nevada share very similar enterprise value EBITDA multiples now, the market is not pricing the extreme growth potential in market capitalization versus Franco. And on a forward basis, Sandstorm is trading at a significant discount, with their 2023 enterprise value trading just above 10 times EBITDA based on my conservative estimates. And additionally, using my 4-quarter projections for 2020, Sandstorm looks to be higher yielding than Franco-Nevada on a free cash flow basis. This is one of the distinguishing factors for why I want to invest in a growth company like Sandstorm versus Franco, and showcases the asymmetric upside that this business has in a positive gold environment. So to summarize, I also rejigged my estimates to reflect a more bearish scenario in gold, margins, and multiples. And looking at our worst case scenario, we can expect to be stopped out at $8.43 with a first price target of $10.57. So now the most exciting part about Sandstorm is the surprise upside that I haven't actually built into the financial model, with the first point being accelerated cash distribution in the form of share buybacks and dividends, Point two being the potential for $2,000 gold activating some of the optionality in their development asset portfolio, which according to management would lead to a bump in 25% in free cash flow terms. However, having adjusted for costs that are going to affect an equity investor's view, I calculated 21%. And then the final point being they are still very small compared to Franco-Nevada and Wheaton, meaning that there is plenty of room for further coverage on the analyst front, which can only be positive for Sandstorm. And to that note, the 7 bullish analyst price targets are around market price, and holds can always be upgraded, which is going to act as a further catalyst to the upside. So I want to thank you for listening. I hope that you found this idea compelling. If you would like to have a look at our macroeconomic reasoning for why we're bullish gold in a bit more depth, that video is going to be linked below. And if you would like to get in touch with me, then please don't hesitate to do so. So thank you so much, and I hope you enjoy the rest of the week.